Hey there, everyone. Happy Friday, May 2nd, and welcome to Chart This with Dave Keller, our special Friday all mailbag episode. I'm your host, Dave Keller. I'm the founder of Market Misbehavior, coming to you from a beautifully sunny Redmond, Washington. We've got highs in the low 70s again today. Pretty awesome 2-day stretch here for Seattle, for the Seattle area. We'll take it. We're actually going to the Seattle Sounders game tomorrow night at Lumen Field. It's going to be back to normal Seattle weather this time of year. It looks like 50s and rainy. So we'll layer up as you do in this region of the country this time of year. And as I was told, there's no such thing as bad weather, only inappropriate clothing. So I'm sure the game will be fun with the family no matter what. Hope you guys are all doing well and hanging in there. Pretty solid finish to the week here for risk assets to be absolutely clear. The S&P 500 having a nice update along with the major equity averages. The jobs data coming out this morning, really suggesting unexpected strength and a lack of negative reaction for now to all of the tariff volatility. We'll look at the charts here together. We'll talk about what this means. The S&P still below its 200-day moving average, still having an aggressive rally off of those early April lows. Is it enough? Is there enough upside momentum to get through and beyond the 200-day? That's the real question for this market. The answer is not yet, but let's look at the charts together here along with everything else. And as a reminder for the Friday mailbag episode, we'll do a brief market update, just checking on some of the key benchmarks in a chart or two, and then we'll get right to the questions, some really good questions to feature that we've received during the show this week so far. All right, looking at the market action, you can see the S&P and the NASDAQ both up in a pretty decent clip here. The S&P was up about 1.5% to 5686 and change. The NASDAQ composite just slightly below 17,000. 19,000 would be pretty impressive for the NASDAQ. 17,980, right? So we're just below that level, very close to the 18,000 point. Both of those up about 1.5% from yesterday's close. Mid caps and small caps even better. And the S&P 400 mid cap index was the best, up 2.4%. We can see the VIX drifting lower, almost 2 full points to the downside. So the VIX just below 23, still above 20, still a far cry from the 50 that we saw, 50 plus level we saw on the early April low. You can look at the 2-day chart of the S&P 500. This was Thursday's session with that sell-off going into the end of the trading day. Big earnings yesterday after the close, Apple and Amazon. The market today opening higher and pushing higher. That jobs number earlier in the day. And by the way, apologies, yesterday on the show, I incorrectly said the PCE number. In my brain, I was thinking the jobs number, but my mouth said the PCE number, which was reported on Wednesday. So sorry if that confused anyone. I got a comment on that, and that was my bad. Jobs data before the open here today. We did get a question I'll feature on some of the economic data we've seen here recently. All right, looking elsewhere. So strong finish to the week, obviously, and I think that, if you're for the bulls, this is a great validation of the just the consistent upswing that we've seen. Certainly this week. This week was even better than last week. We had some of those distribution days in there. Not the case this week. This week was pretty strong. Bonds moving lower here, and one of the big, outcomes this week is the investors pushing out their expectations for the yield curve, and that's one of the not for the yield curve, for the Fed. So basically, zero chance of the market of the Fed lowering rates at next week's meeting. That'll be the next one. Market pricing in a 99% chance that rates remain the same. At the June meeting, it's a 2-to-1 ratio, right? 65% chance that they remain steady, only a 34% chance that they lower. About a month ago, it was almost reversed. It was a 61% chance of a lowering in rates and only a 33% chance of keeping rates stable. So the market is basically pushing out that first rate cut. It seemed very obvious that was going to be at the June meeting. Now, market is pricing in that really doesn't happen probably till the July meeting. And maybe we still have those 2 rate cuts that have been priced in, but they just start a little bit later. So again, the economic data generally kind of supportive this week, certainly through the end of the week here. So today, the TLT moved down 1.1% Interest rates generally moved higher. The 10-year yield finishes the week right around 4.32. The 5-year point just below 4%, and the 30-year point just below 4.8%. The dollar essentially flat, although it opened much lower looking at the UUP and drifted higher through the course of the day. So you have stocks going higher, bonds going lower. This is basically a risk-on kind of move through the week, and especially on Friday. Interesting to note that gold actually held yesterday's close, opened a lot higher today, drifted lower into the lunchtime hour Eastern time, and ended up holding that. So the GLD ended up 0.2% today. Again, so gold has been in pullback mode certainly here this week, but holding steady today. Silver price is down about 1%. Copper price is slightly higher. Crude oil price is slightly lower. It's kind of mixed results there looking at commodities. Cryptocurrencies continue to look quite strong after Thursday's strong day for Bitcoin, continuing to the upside. Almost hit 98,000 earlier today. Currently trading just above 97,000. That's up about 0.5% from yesterday's close. So overall, you see cryptocurrencies continuing, particularly Bitcoin, continuing sort of an uptrend that we've been experiencing here from April into May. Looking at sectors here on Friday's session, you can see financials number one at 2.1%. You had some big earnings in financials, particularly the payment processors like Visa and MasterCard this week. Industrials number two, up 1.8%. Technology and materials tied for third place, up 1.7%. All 11 of the S&P sectors finished up today. Consumer staples, utilities, and real estate, and then healthcare, the four defensive sectors at the bottom of the leaderboard, all up. Consumer staples, the worst performer, still up about 0.5%. So it's very much a risk-on week, very much a risk-on day. As we've talked about, this is a brilliant rally off of the April lows. Undeniable, would not deny that. My question, which we've posed in the last couple of weeks, is it enough? Is there enough momentum left after you get to this point to propel us back above the 200-day moving average? And that's the question we'll have to answer next week. Breadth today on Friday, pretty strong. It was actually a 90% update for the mid-cap index, about 88% of the S&P 500 higher, 74% of the NASDAQ 100 on the broad New York Stock Exchange, 82% up on Friday's close. So again, brilliant end to the week. For the bulls, what a great way to finish this week going into the weekend. I'll take it too. Nothing makes me happier than that. All right, let's look at the Magnificent Seven growth stocks here. You can see Meta, really testing resistance today after earnings this week, finishing the week strong, up 4.3%. Broadcom, number two, up 3.2%. Apple, the only name really of this basket really struggling, although Amazon was flat here after earnings yesterday. But Apple was down 3.7%. So it certainly looks like, which of these is not like the other. Apple certainly looks like the one that is struggling the most, with the most, negative reaction to earnings so far. I compare that to like a Netflix post earnings has made new all-time highs and just continued going up another 2% today. Apple really languishing after that earnings call and other news. All right, so let's look at these two charts here to finish off, and then we'll look at the mailbag questions again, which have been really good questions here recently. I'm excited to get into these. So here's the daily chart of the S&P 500. We've broken above 5,500. That's happened last week. We've continued higher. Besides yesterday closing below the open, there's a lot to like through the course of this week. 5,750 to 5,800. That remains sort of our upside target based on the rally off of the early April low. And again, this has been a brilliant move higher. We're now facing this swing high from earlier this year in late March. Also lines up at the 200-day moving average. So again, this is kind of where you'd expect resistance, particularly if you're bearish. I don't know if we can go much higher than this before you have to start thinking enough's enough. I really need exposure on the long side. And again, the RSI is pushing 60, did not finish the week above. They're kind of hitting right there. So again, the bear case here is we stall out and roll over. I think next week is going to be pivotal, and we'll see if there's enough momentum left. The last 2 weeks have been remarkably strong, surprisingly strong, if you ask me, given the conditions in mid-April. But for now, continuing to move to the upside. This is what I call the chart, just combining some of the key breadth measures. And I just want to focus on the three at the bottom here. If you'll note, over 50% of the S&P 500 members finished the week above the 50-day moving average. And I haven't been able to say that since the end of February. That's the last time over half of the S&P were above their 50-day moving average. I think that's pretty meaningful. It's a short-term measure of breadth, but other short-term measures of breadth have all been very positive, right? The McClellan oscillator has been above zero. This indicator now following through to the upside. The S&P 500 bullish percent index finished the week just above 70%. We highlighted recently how the NASDAQ 100's bullish percent index is now well above 70, continues there to this day. Now the S&P's bullish percent index is above 70. Here's the problem, right? Just like a lot of these indicators look very bombed out and so negative, they were positive at that April low. And I interviewed John Roque of 22V Research. We'll put that episode out probably this evening or tomorrow morning. So check it out over the weekend if you like. I mean, he's just one of the great technical analysts. Has been on the buy side, been on the sell side, has worked with institutional investors pretty much his entire career. Just a really thoughtful, knowledgeable analyst, and I hope you appreciate it. We talked about some of the breadth conditions and some of the bombed out indicators at that early April low. Indicators like this are now showing the opposite. They're showing that this runoff of the April low has kind of become exhausted to the upside. So, it's not necessarily saying we end today, but it's saying we're at that point where you look for a rollover. And so the fact that that's happening as we reach our upside target of around 5,750 to 5,800, has me skeptical that there's going to be enough momentum to get through. If we break above 5,800, I don't think you can be bearish at this point. I think you have to, again, our market trend model, I'd love to see the medium-term model turn bullish to sort of confirm that breakout, but that's sort of where we're looking here with conditions improving going into the weekend. All righty, let's get to some of these great questions here. Let me switch this screen around. And question number one, again, as a reminder, all these questions come from viewers like you through the course of the week, either in the live broadcast or watching the replay and putting a comment on our YouTube channel. We appreciate your questions so much. Makes the show interactive, makes it lively, makes it dynamic, and really helps me tailor the content to the types of questions you guys are asking. And I appreciate so much you sharing your questions as they come up. So let's get to question number one. Dave, I see you sometimes use the 150 period moving average, often on weekly charts. What's the specific use and significance and purpose of a 150 period moving average as opposed to the more widely used 200 period moving average? Awesome question. And honestly, I appreciate the question. I get asked a version of that question very often in different formats, in different forums, and I'm happy to answer it. So my go-to chart is this one. This is the first chart I look at. If you ask me, what do you think about IBM or Home Depot or KLAC or some random ETF, I'm going to bring up this chart. It's a 2-year daily chart, has the 50 and 200-day moving averages. It has RSI and it has relative strength. I often will start here and then go to other things. If I'm thinking a little more longer term, or if we're at a key level, I'll bring the weekly chart to sort of bring in more data. Look at the last 5 to 7 years. If I'm thinking more short term, maybe I look at the hourly chart or the 5-minute chart to sort of, really identify short-term swings. Depending on where we're at, I might look at other indicators like PPO or the Ichimoku cloud or something like that, just to sort of provide further context about where we're at. But this is sort of my starting point. Now, the reason why I use the 50 and 200-day moving average, I've worked with investors of different levels, from beginner retail investors to well-established institutional money managers and kind of everyone in between. And the most common combination I've seen is this particular combination. This is the default moving average combination on most charting platforms. A lot of people who are casually interested in charts, but not deep technical analysis aficionados, seem to kind of be very aware of the 50 and the 200-day moving average. So I don't think it's a surprise that a lot of things sort of, pivot on their 200-day. And I've been on buy-side trading desks where they'll literally use that as a level with which to inform their positioning. And so I think there's value in that. Now, here's a question. So on the daily chart, that's what I would look at. And I rarely look at other moving average combinations other than that. Now, on the weekly chart, the 200-day moving average, basically the weekly version of that is the 40-week. So on my weekly charts, I actually show the 40-week moving average. It's in red. So the 200-day moving average is red on the daily chart. The 40-week, which is kind of like the 200-day, is also red. So I just have an idea of where we're at relative to that. But For longer term data, if I really want to understand the longer term trajectory, you need to use longer term averages. And the 150 week is something that a number of people, I want to say, now you're going to ask me maybe where exactly I got this from. I don't know. I've been doing this a couple of years now, and random things like where I got that is a tough one for me to answer. I want to say it could have been like a Carter Worth thing. That sounds right to me. I remember debating with him about moving average combinations, and we looked at the 150 week. I know that in my Fidelity days, we spent a lot of times just testing different moving average combinations. And, in the course of talking with a lot of different experts, I was faced with a lot of different tools and techniques. And the 150 week became very quickly my go-to gauge for longer term trend analysis, right? So just like on the daily, the 200-day moving average just tells me that good long-term trend on that time frame. On the weekly chart, the 150 week, I think, is very telling, right? A flat 150 week tells you we've been in a sideways trend. An upward sloping 150 week tells me the primary trend is probably up. Now, these are big cyclical moves on the weekly chart, but if you're zooming out 5 to 7 years, you really want longer term trends. So that's kind of how I do it. Now, randomly, you may find me show a daily chart with the 40-day and the 150 week, and that probably means just I messed up the settings on the chart and I forgot to set them to the right moving averages. That's not on purpose. I'm not perfect, and I make mistakes like that way more than I would like to, but it happens. That's why I use those moving average combinations. I'm not a big hard and fast, these are the right ones to use, because I feel like with different charts and indicators and settings and periods, it's really less about me telling you the right thing. It's more about you answering that question for yourself based on your investment goals and how you're approaching things. There may be a different moving average combination that works for you and how you're actually trying to play the game. I hope you take time to evolve your process based on what's most going to help you answer the questions you're trying to answer in your portfolio. Next question. My amateur fundamental analysis, I love the humility in your question, by the way, says that the economy is in bad shape with this week's numbers. Would you agree? Now, and full disclosure, you did send this in before today's reading, which was the jobs numbers came out earlier today, and we're actually much stronger than expected. So a couple of comments on here, right? I mean, if you're looking at the chart of the S&P, it's like, the market has gone, straight down with the announcement of tariffs, right? And what you have to remember, at least this is the way I've learned to understand movements. Anytime there's a big move in the equity markets, we always want to know why. Why did the market bottom out at a certain point? What caused the sell-off? What caused the rally? And financial media loves asking that question. And I've worked at financial media outlets where you're not allowed to write a headline without attributing some causality. You can't say the market was up today, full stop. You have to say the market was up because of optimism about Trump's new plan, or because of, lowered concerns about inflation. The market was down because of concerns about geopolitical issues, right? Just to frame out a story and make it seem like everything makes sense, you have to do it. Now, in the reality of day-to-day movements in markets, sometimes markets just move. Sometimes stocks just fluctuate. It's less about everyone reading one report and then all reacting a certain way. Remember, the price action kind of aggregates everything. Sometimes people just get nervous. Sometimes people get way too excited or way too, panicked about something. And so the markets kind of overshoot what they probably should do. So again, I would say, what your question really is like, why is the market going up so much if the economic data is as bad as it looks? So here's the thing. What you have to remember is the equity markets aren't pricing. They don't trade based on what economic number just came out, because most economic data is super laggy, meaning right now we're reporting on like the GDP from a couple months ago. We're reporting on jobs data that's been collected over time. We're reporting on inflation data that has a lag, right? The recession is actually confirmed way after it started, and oftentimes after it's ended is when economists can declare with certainty, oh yeah, that was a recession back there. So economic data just takes time to gather all the data. It takes time to, determine the right numbers and to sort of do it out. And look at how often, if you really want to blow your mind, look at how often economic data is restated. Often, like a little later, they get more data to sort of validate. They go, wait, actually that number back there that we talked about last month, it was actually a little higher than we thought. So there's a built-in lag to all that, just because it takes time to collect whatever that data is. There's a process, right? It's not instantaneous. So economic data is really laggy. So what's not laggy? What's a leading indicator? It's the stock market, right? So all the stock market is trying to do is look forward months, quarters, years down the road and trying to project what companies are going to be able to do. How are companies going to be able to grow earnings? I mean, it's all about trying to predict what could happen down the road. And so when the market's rallying and it rallies because of, some economic release comes out and the market moves higher, that basically is a bunch of, investors looking at this new data point and saying, all right, what does that tell us? Not about what happened before, but what's going to happen way down the road, because that's what we're trying to do, right? And so, the market can rally on bad economic data. The market can sell off on good economic data, because it's not about this data point. It's all about how that helps us maybe better anticipate data points that we'll learn about months down the road. And so the month of April was all about, going into April, the market had been selling off from mid-February, down to the beginning of April. The moment tariffs were announced, it totally changed the picture. And to this day, still changes the picture. Everything's different, right? In terms of our negotiating, strategy with other countries, with different governments, and how they're, negotiating with the U.S. and with each other. It's the future of the dollar as a reserve currency. The long-term impacts of things like tariffs and stuff that are so uncertain right now, it's really hard to guess. So the market is rallying, assuming that I would guess, assuming that the impact of tariffs is not going to be that bad, right? It's not going to be as bad as we thought in early April. Early April, this came out, it's like, oh my gosh, it's the end of the world. All of a sudden, tariffs are delayed for a while, and it's like, okay, maybe this isn't going to be that severe, and maybe at the end of the day, it'll actually be a lot more manageable. The problem is there's not an instant, it's not like tariffs are announced and we feel the impacts immediately, right? I would argue the jobs data we just saw probably isn't reflecting tariff stuff, because there's a lag between, okay, a company's costs are going to be more, so they start changing inventories, they start changing their purchasing strategies. It takes, months before that affects hiring decisions, and it affects how we're acquiring inventory and where we're pricing things. And so, and what's being shipped to the US, right? So, there's a lag that I feel like the market is ignoring right now. So you could probably tell from how I'm describing it, I'm skeptical that the market keeps going higher. I think there will be more negative, moments where we say, there are ripple effects we didn't think about that probably come due and cause the market to go back lower. But that's the that was a long-winded answer. I apologize for that, but that's sort of what I would tell you. The general trend in economic data has not been good. I think the GDP being negative for the first quarter is probably the most, not encouraging thing that I've seen. That's halfway to a recession. We won't know that until, after the end of June into July and or August is when you start to learn whether, we actually are formally in a recession. But the fact that the economy is technically shrinking is not great. And just the question is, what are the market's expectations for what happens next related to those things? We'll see. That's my long-winded answer. But again, a lot of times people look at economic data to predict the stock market. That's totally backwards. One of the best predictors of the economy is the stock market. So you can't use economic data to predict what's going to happen with stocks. You want to use stocks to predict what's going to happen with economic data. The market will recover before the economic data actually starts to turn higher. That's if you look back at market history, that's how things have played out. All right, we got to continue on here. I do want to let you know, though, about a pretty interesting thing happening at Seeking Alpha. I want to thank Seeking Alpha, as always, for supporting the channel. We did a video earlier this week, just actually released earlier today, about dividend investing, highlighting some of the tools on Seeking Alpha that allow you to find consistent dividend payers. You can check that video out on my YouTube channel. They're running a spring sale right now. If you use my link, marketmisbehavior.com/Seeking Alpha, you can get $30 off Seeking Alpha Premium. They also have a product called Alpha Picks, which is an add-on product that you can have, and they will give you the next Alpha Pick for free. So you get to get a taste of that. I interviewed Stephen Kress, who's the head of the quantitative research department at Seeking Alpha, earlier this year on my podcast. You can find that on my YouTube channel as well. I'll try to put links to both of those in the in the description for today's show if you want to check it out. So go to marketmisbehavior.com/seeking alpha for more info on that spring sale. You can use a QR code as well to get to that page. Check it out, and I hope you use it to help upgrade your decision making and your market awareness here going forward. All right, next question. What metrics should one use to differentiate a pullback to enter a trade from the beginning of a corrective phase? Sorry. Well, yeah, sorry, the wording of that one got me, but I get it. How do you differentiate like a pullback versus a big correction and at the beginning of something worse? Right? When something pulls back, how do you know it's just a pullback? So the short answer is you really don't, right? You don't know for sure. And that's the thing. A lot of people look at charts and technical analysis expecting perfection. And I'll tell you from the moment, I mean, literally the moment years ago, and it was after I left Fidelity, because when you're out of Fidelity, I wasn't able to use social media at all. This was, 2008 to 2016 after I left, and I actually, started a Twitter account and started publishing on social media because I no longer had a compliance department. The moment I started putting a chart out with the technical indicator, and the moment it didn't play out, I remember people just completely trolling like, oh, that was a miss, horrible call. And it's like, I mean, if you go into any sort of investing discipline, assuming to be right all the time, I mean, talk about not getting it, right? You're going to be wrong a lot. You just are. That's the reality of investing. It's not about being right all the time. It's when you're right, you stay right. And when you're wrong, you stay wrong. So my first sort of caveat is anything I'm about to show you, it's not going to work all the time. I wish it did. It would make things a lot easier, but it doesn't. So the best thing you can do is the best thing you can do. So if, a chart like Kroger is a good example of a stock that's been in a primary uptrend, has a lot of these little pullbacks along the way. So, so how do you, differentiate like a brief pullback versus something that's much more significant? I mean, if you look at what happened here in like March, April of 2024, this is after a breakout above resistance, new 52-week high, we continue higher, then all of a sudden we make a lower peak, and all of a sudden we break below the 50-day moving average. That kind of move, right? In a consistent uptrend, you often hold the 50-day moving average. If you break it, it's not by much, and you usually recover it very, very quickly. But breaking an ascending 50-day moving average is often a sign that, okay, maybe this isn't a good pullback, and maybe there's more to come here, right? If we continue to break out, then maybe you go back into the position. So you expect pullbacks to hold an ascending 50-day moving average or a 10-week moving average. If that doesn't happen, maybe it's something different. Another way is, in a bullish phase, pullbacks usually mean an RSI stalls out around 40, meaning it doesn't get much below there. But you can see when the RSI does go below 40, that probably tells you, okay, this isn't just a garden variety pullback. Maybe this is the beginning of something more significant. So, the best thing you can do is think, all right, this sort of move, the long-term trend is still good because we're still above key moving averages. The short term is weak. Maybe that's an opportunity to buy on the dip. Anytime you're buying on the dips, though, you're buying into weakness, into short-term weakness, which means you have to use good money management strategies, right? You can't just buy and assume it's going to work perfectly. What if it doesn't? So stop losses, when you're buying pullbacks, you make sure you use a stop to minimize the pain in case you're wrong, right? If it was, so it's not about being right all the time. It's not about always picking the right pullbacks. You buy a number of pullbacks. If they work, you're great. If they don't work, you limit your losses, right? And so, again, don't think it's about predicting ahead of time whether the pullback is going to hold. Make sure you just, when it does hold, make sure you're in the trade. And when it doesn't hold, make sure you get out of the trade quickly. So I think it's more about money management than about predicting the future. Having said that, those are some of the tools and techniques that I've used. Looking at the 50-day moving average, do we hold it? Looking at the RSI, does it hold 40? If those kind of things, if those boxes can't be checked anymore, that often means it's something more significant. There are other trailing stop indicators, which you could look at as well. Parabolic systems or parabolic studies, which is an indicator created by Wells Wilder, the same guy that created RSI, might be one to look at. I would say, something based on average true range is often a really good approach. So the chandelier exit system that Alexander Elder popularized in his books is really, really good as well, because that focuses on volatility. So the more volatile the stock, the wider the stops, which is a good way to approach that kind of money management. All right. We have to make this the last question, but let's do it. Did the big base breakout method have a quantitative measure so you could actually assign a metric and compare it from one time frame to another for the same security? Yeah, this might have been last week. I forget when I saw that question, but I've been saving it, and this seemed like a good day to bring it up. To the big base breakout method we talked about, and I forget what chart that was. But Kroger's not a bad idea because I kind of have it up here. A big base breakout is basically you have a rally and then the rally's no longer happening, right? We stop going up and we start pulling back. And then all of a sudden we sort of make this rectangular pattern. So maybe this isn't a perfect one, but good enough for an example. Kind of have this consolidation phase, right? The market's not in an uptrend or a downtrend. It's in a sideways neutral trend. And you wait to see when we break out of that base. And that's why it's called a big base breakout. And by the way, I learned of this specific naming and approach from Bill Doan, who was one of my predecessors at Fidelity. He ran the technical research team in the 1970s. He was pretty, up in years when I first met with him, years ago when I was running the team at Fidelity. Unfortunately, he passed away while I was there. But I did get a chance to meet him a number of times, and he was very gracious about sharing great stories of that period and talking about the chart room and how it had evolved and all sorts of really cool stuff, which I'm thankful I had the opportunity to learn from him in some way. But at the time I had met him, he was running an independent firm called Minuteman Research, I want to say, based in the Boston area. And he would, to that day, still look for big base breakouts. That's what we call them, which was like a big consolidation pattern. And you look for that break to new highs. And that approach just works so well. Not always, but often. So your question is, does that method have a quantitative measure? No. And that's one of those things that's more subjective. It's more of a visual, pattern. It's really tough to back test things like, triangle patterns, because it's more of a visual pattern. You can teach a computer what a triangle is, but it's still kind of tough to quantify in a consistent way. It's not like a, buy when the MACD gives a buy signal, because that's not a judgment call. It's like the signal happened. Okay, we can start doing it. And so using big base breakouts and using triangle patterns or cup and handle patterns, they're very tough to systematically test. It's more visual, and it's more how it fits into to your approach. So no, I would not say it has a great quantitative measure. If I was going to test it, I'd probably look at stocks making new 3-month highs as an initial assessment and then sort of build off of that. But it's not something I've ever tested. Things like big base breakouts, in my experience working for money management firms, we did very little back testing, right? It's not like we back tested every indicator and really looked at the statistics and then decided whether to use it. We would just run live money or a model portfolio using the techniques and using the combination of techniques. And if the portfolio made money, we used that more. And if the trades didn't work, we stopped using those techniques. So the techniques and the indicators and the approaches that I show you, I can't show you a back test I've done for every one of these indicators, and this is why I use them. I've just used them in the money management experience, and the things that didn't work, I don't use them anymore because they didn't work, because they weren't helping us. The things that I am using are the ones that we found really helpful. These are the ones that helped us grow assets, and so that's why I continue to use it. I would tell you though, if that is the type of question you're asking, there's a book by David Aronson named Evidence-Based Technical Analysis. He is part of a subgroup within the technical analysis community. The technical analysis community, it's interesting. They're a group of us, which I would more describe which are more behavioral, right? I'm talking about investor psychology, using charts and indicators as a way of visually representing what investors are thinking and the sentiment, the emotions of fear and greed, and how they're reflected in asset prices. There's another whole subgroup in the technical analysis community, which are more statistically oriented, that are designing trading systems that are, trying to really, quantify and use statistically significant methods to back test and to optimize and to do that. It's just not the area of technical analysis that I tend to focus on, but they're out there. And there are a number of books that I would recommend, but that's one I would start with. It's by David Aronson. I'll put a link in the description or in the comments on my on this video on YouTube. So if you want to check that out, you can get to that book if you like. Folks, that'll do it. Some really good questions today. I want to thank you guys so much. I didn't get to all of them, but I'll put them in the mailbag and keep them there and make sure that we get to them in a future episode. But thank you guys so much for a great week. Again, and the markets are volatile. The markets have had big up moves and big down moves and everything in between over the last months. I enjoy a great deal following the markets, analyzing them, sharing ideas with you, answering your questions, and just helping you, try to make sense of things. And I'm thankful for the opportunity to do so. And I hope you appreciate the show and the content we're putting out there. So thanks so much for watching. Have a wonderful weekend. And remember, it's always a good time to own good charts. Have a great weekend, folks. Bye now.